Welcome to the Teaching You to Fish podcast, financial literacy for the rest of us. My name is Carl Fish, and I'm the host of this podcast. This is episode 6, Employer Benefits. When people think about the financial implications of taking a job, or about the job they currently have, they usually focus on their pay, and that's certainly an important consideration. While people know and appreciate that they also get benefits, they often don't realize how much those benefits really amount to, often as much as between 20% and 40% of their pay. When I was younger, these were even referred to as fringe benefits, which kind of gives you an idea of how much importance people gave them. But these benefits are anything but fringe, and most people should spend a lot more time thinking about them. While ideally you should think about these benefits when considering taking a new job, that doesn't mean you also shouldn't take some significant time to think about the benefits you have right now and whether you are optimizing them. Before we get into the specifics of employer benefits, I want to talk a bit about the purpose of insurance. Many folks in previous generations grew up with the idea that insurance was supposed to pay for things, particularly when it came to medical insurance. The feeling was that insurance should pay for everything, or almost everything, and we, individuals, should pay very little. Setting aside any political viewpoints, under our current system, this just isn't possible. Insurance companies have to make enough money to cover expenses, which includes any claims you make plus the overhead of administering the program, and if they are for profit, have to make a profit above and beyond that. Only way to do that is to make sure the combination of the premiums you pay plus any out-of-pocket expenses you pay adds up to at least what their expenses are plus whatever profit they make. Every individual's situation is unique, of course, but generally you want to purchase the least expensive insurance that protects you from catastrophic expenses. That's the original idea behind insurance, that a group of people pool their money so when something unfortunate happens to one person, their life isn't ruined. For that to happen, however, there have to be other people who end up paying more for insurance than for the benefit they actually receive. Instead of looking at insurance as paying for things, try to reframe your thinking to insurance as protecting against catastrophe. You're going to need to pay for the things you use. Insurance is there for the hopefully uncommon occurrence of massive expenses. Your house burns down, or you have a major medical condition. If you make your insurance choices with that mindset, you will most likely choose to increase your deductibles, whether that be for car, house, medical, or whatever, in exchange for lower premiums. That provides you the security that if something tragic and expensive occurs, it won't bankrupt you, while still paying for the services you use. It will also likely lower your premiums for insurance, which provides you extra cash along the way. It's really important to set aside that cash to cover the increased out-of-pocket expenses you may have. As always, it's going to be a balancing act. You may not want to choose such a high deductible that it's a problem should something happen and you have to cover it out of savings. But many people end up choosing too low of a deductible out of fear, not realizing that the extra premiums they are paying for those lower deductibles would have covered much of the difference of that higher deductible. Your employer likely covers at least some of your premiums for health, dental, and perhaps vision insurance, but you have to pay the rest. Most employers offer at least some choice of plans, with the difference between the plans mostly a trade-off between a higher premium with lower out-of-pocket expenses or a lower premium with higher out-of-pocket expenses. Choosing a health insurance plan, and dental and vision, is a very important decision, but it's not the only decision most of us have because our employer typically offers many other benefits as well, and they can be very important. Before we start, a short assignment for you. I need you to gather all of the benefits that are available to you, as well as the specific benefits you've chosen and what you pay for them. Most employers have a PDF or a website that lists all of the available benefits, as well as any costs associated with them. Make sure you have that. Then, go through your recent pay stubs and make a note of all the benefits you have chosen. Things to look for include, but are not limited to, which health, dental, and vision choices you have made and what premiums are you paying. Are your health, dental, and vision insurance premiums coming out pre-tax? Are you and/or your employer contributing anything to a medical FSA, limited purpose FSA, health savings account, HSA, or dependent care FSA? If so, make a note how much you and/or your employer are contributing. Are you paying for any supplemental insurance through your employer, such as life insurance, accidental death and dismemberment insurance, critical illness insurance, accident insurance, or similar? If so, make a note of which ones you have chosen and how much you are paying for them. Are you contributing to any employer-sponsored retirement plans, such as a 401k, 403b, or 457b? If so, make a note of how much. Does your employer match any of your contributions to a 401k, 403b, or 457b? If so, make a note of how much. We'll talk more about investing in employer matches in a future episode. And if you have a partner, do the same things for their employer benefits and their pay stubs. Stop the podcast until you've gathered the information. Now that you've gathered all of this information, let's take a look at some specifics. Many, but not all, employers offer a choice of healthcare plans, with the difference between the plans typically including the premiums, copays and coinsurance, the amount of the deductible, out-of-pocket maximums, and what network of medical professionals you're allowed to access. These generally come in two distinct types, either a PPO DHMO or a high-deductible health plan. For simplicity's sake, from here on out I will just refer to the PPO DHMO as PPO. Some people have choices of both types, some just have one or the other. Both types cover preventative visits at no charge. A PPO is a type of health insurance where there is often a relatively small deductible, but you also have copays for certain types of medical services even before you reach your deductible. For other services, you may have to pay out of pocket until you meet your deductible, then you typically have to pay coinsurance after that. A fairly typical coinsurance amount is 20%. So for any expenses after you meet your deductible, your insurance will pay 80% of the cost and you will pay 20%. If you have a particularly costly healthcare year, all policies under the ACA have an out-of-pocket maximum. Once you reach that maximum for the year, you don't pay for any other covered healthcare costs for the rest of the year. If you have multiple choices of PPO plans, the differences between them are typically in the deductible amount, the coinsurance amount, and the out-of-pocket maximum amounts. The lower those amounts are, the higher your premiums. A high-deductible health plan, HDHP, on the other hand, does not have any copays or coinsurance right off the bat. You are responsible for all costs up until the deductible, which is typically, but not always, a higher deductible than with the PPO plans. Once you meet the deductible, then you typically have a coinsurance amount for any costs after that, where you pay your 20% or whatever, and the insurance company pays the remainder. Again, once you hit your out-of-pocket maximum for the year, all of the rest of your healthcare expenses are covered in full. If you have multiple choices in HDHP plans, the differences are usually in the deductible amount, the out-of-pocket maximum, and sometimes the coinsurance percentage. Again, the lower these are, the higher your premiums. Another difference sometimes is whether the HDHP is HSA qualified, meaning whether the plan allows you to contribute to a health savings account, an HSA. Sometimes your employer will even contribute to your HSA for you, and then you can contribute additional amounts if you wish. The HSA is an important feature, and I'll talk more about it later. As always, you have to look at the details of the plans your employer offers, but in general, the following is likely to be true. PPOs will likely have higher premiums and lower deductibles than HDHPs. Because of those higher deductibles, many people are scared of the HDHP and choose one of the lower deductible but higher premium PPOs. Often, however, this is not the best choice. It's frequently, but not always, better to take the HDHP. This is because the savings you get from paying lower premiums, plus if your employer contributes to your HSA for you, can outweigh the difference in out-of-pocket costs. Now, to be clear, this totally depends on the plans you have available to you, the coverages and premiums associated with those plans, and your individual health circumstances. You'll have to do the math for your specific plans and your specific healthcare needs. But don't assume that the HDHP is a worse choice than a PPO. In my work with teachers around Colorado, in most school districts I've looked at that offer both PPOs and HDHPs, the HDHP has been the better choice for almost all employees. For the moment, let's assume you have chosen a PPO. If you have multiple choices, How do you know if you've picked the right PPO? Ignoring any differences in the network of medical professionals available to you, which can be important differences, this is really a comparison of premiums versus potential out-of-pocket costs. Many folks often try to pick some kind of middle ground between premiums and out-of-pocket costs. But this is a case where you should do a little bit of math, because what most people don't take into consideration is that you pay premiums no matter what, but out-of-pocket costs depend on how much health services you actually need each year. The math you need to do with your employer's specific health plan choices and premiums is to calculate how much your premiums are each year and compare that with the potential cost of healthcare services. In some cases, the premium savings covers most of that difference, and sometimes more than that difference. And the crucial piece here is that if that's the case, you likely want to choose the plan with a lower premium and higher potential out-of-pocket costs, because those premium savings are guaranteed, whereas the out-of-pocket costs only happen during years when you need those health services. Depending on the math for your specific plans and premiums, it may be very likely that you will come out ahead most, perhaps all, years by choosing the less generous coverage because of the upfront premium savings. Again, to be clear, you have to do a little math to be able to make the comparison, but take the time to do that math. And you definitely want to make sure that your insurance premiums are coming out pre-tax. Most employers likely do this by default, but it pays, literally, to make sure. While dental and/or vision insurance premiums are not as consequential, the same types of calculations apply if you have choices of coverages. With dental, it often makes sense to choose the lower coverage with the lower premiums, but then switch to the higher coverage during years you know you might have higher expenses. A typical example, when your kids need braces. For vision insurance, many people don't need this at all. Often the amount you spend on premiums is more than the amount you save by utilizing the insurance. Again, be sure these dental and vision premiums are coming out pre-tax. Sticking with assuming you have a PPO, you need to check to see if you have access to a medical flexible spending account, medical FSA, but usually just referred to as FSA. Many employers, but not all, offer this. If yours doesn't, ask them to consider offering it. Medical FSAs often have a bad reputation, and some, but not all, of that reputation is deserved. Some FSA providers make it too difficult to get reimbursed and/or question whether your expense qualifies. If that's the case for you, then consider asking your employer to explore other providers and see if maybe they can switch during next open enrollment. The other reason medical FSAs get a bad rap is the use it or lose it feature. The same law that authorizes FSAs also requires that you spend everything you put into an FSA each year, and if you don't, then you forfeit what remains. This was designed to discourage misuse, but unfortunately, often actually discourages people from using it at all. So let's take a look at how medical FSAs work, why I think you should be taking advantage of yours, and why use it or lose it isn't completely accurate. The basic idea of a medical FSA is that you contribute money to an account directly from your paycheck to pay for future out-of-pocket medical expenses, including medical, dental, and vision expenses. But this is more than just a let me save for medical expenses, because your contributions come out pre-tax. That means it comes out pre-federal tax, pre-state tax, if you have a state income tax, pre-Social Security, if you contribute to Social Security, and pre-Medicare. This ends up being a huge savings. We'll look at how much a bit later in this episode. The amount you can contribute changes each year, but in 2025, the maximum amount is $3,300 for an individual. If you have a partner and both have access to an FSA, you can each contribute up to $3,300, so a maximum of $6,600. The problem arises that you generally don't know in advance how much out-of-pocket expenses you'll have in any given year. So many people end up not contributing anything because they are worried they will contribute too much and have to forfeit some of it. Probably not surprisingly, I think this is a bad reason not to contribute to an FSA. First, most people should be able to get a pretty decent idea of how much they typically spend out of pocket on medical, dental, and vision expenses by looking back over their spending account and/or credit card statements for the past year. Simply add up all the expenses you paid for the year. If that was a typical year, then that's probably about the right amount to contribute to your FSA for the following year. If last year was a particularly high or low year, adjust accordingly. And there are many expenses that are fairly predictable each year. If you have regular prescriptions that you pay for, and remember, you can use FSA money to reimburse for expenses incurred by anyone in your family, not just yourself, you know you're going to have those and about how much they will be for the year. If you know you or your family typically goes to the doctor a certain number of times a year, you can add in the copay or deductible amount for those visits. If you or your family go to the dentist twice a year, you should be able to estimate any regular costs associated with that. If you or your family regularly go to the eye doctor and get contacts or glasses, you can add that in. And there are many things that you might think of as just supplies that can also qualify for FSA reimbursement. And companies like Amazon and Walgreens have readily available lists if you want to shop there specifically. After going through that process, you should be able to get a pretty decent estimate of at least the floor of your yearly spending and contributing at least that amount to your FSA. But let's also talk about the use it or lose it provision, which, as it turns out, is overstating it a bit. First, because of the tax savings you get for contributing to the FSA, even if you don't use all of it and have to forfeit some at the end of the year, it's very possible you will still come out ahead. We'll look at this more closely when we do an activity in a few minutes, but for now, let's assume that you are in the 22% marginal tax bracket for your federal taxes, 4% for state taxes, 6.2% for Social Security, and 1.45% for Medicare. Because FSA contributions come out before all of those, for every $100 you contribute to your FSA, you are saving $33.65 in taxes. What that translates to is that as long as you spend at least $66.35, the $100 minus the $33.65, you will break even or come out ahead. So even if you don't spend the full $100, if whatever you forfeit is less than your tax savings, you win. The second piece is that the law allows your FSA plan to let you roll over up to 20% of the yearly maximum to the following plan year. But your plan has to implement that feature. If your plan doesn't allow this, ask your HR department if you can get this feature added. For 2025, that means you could roll over up to $660 to the following year if you don't spend it. 20% of the $3,300 maximum is $660, which means you have a built-in $660 safety net, plus another $222 from the tax savings from those $660 in contributions. So you could contribute over $880 with zero risk, even if you had $0 in health, dental, and vision expenses for the year, and you didn't have any carryover from previous years. So the shorthand of use it or lose it is leaving out some important nuances. There's a second FSA that your employer may offer called a dependent care flexible spending account. Again, if your employer doesn't offer it, ask them to. While dependent care can refer to care for any dependents, including elderly parents, most of the time you can just think of this as daycare expenses. The contribution limit for dependent care FSAs is currently fixed at $5,000 per year and, unfortunately, is not currently adjusted each year for inflation. In addition, the $5,000 is the total for you and for your partner if you have one. Unlike the medical FSA, you can't both contribute the maximum. The $5,000 is the total you can both contribute. If you have kids in daycare, it's pretty likely that you spend at least $5,000 each year on daycare expenses, so you likely will be able to max this out each year you have any children in daycare. Note that any expenses above the $5,000 you can claim separately when you file your taxes. Again, because this comes out pre-tax, this is like getting a 30% discount or more, depending on your federal and state tax rates, on the first $5,000 of daycare costs each year. We'll talk later in this episode about a third possible FSA, the limited purpose FSA, that your employer might offer, but you can only use this one if you also have an HSA qualified HDHP. In addition to the tax savings, there's also one more bonus of using FSAs. They lower your adjustable gross income, AGI, on your federal taxes. While it may seem like that's the same thing as saving on your taxes, the bonus is that there are other tax credits and deductions that are sometimes allowed, but that phase out with higher incomes, such as the American Opportunity Tax Credit, income-based student loan payments, and even qualifying to contribute to an IRA. By using FSAs to lower your AGI, you just might qualify for more of those. We'll talk more about those when we get to our episode on taxes later in this series. So let's take a look at the possible savings for you from using a medical FSA and/or a dependent care FSA. Before we start, you're going to want to know the following things. Your marginal federal tax rate. That's the tax rate you pay on your highest dollar. For the majority of folks watching this, that's probably 22%, but yours could be different. Your marginal state tax rate. This varies tremendously by state. Some states don't have any state income tax. Some have a flat tax rate, and some have progressive tax rates where you need to figure out your marginal rate. Again, the tax that applies to your highest dollar earned. You need to know whether you contribute to Social Security or not. Some folks with a non-covered pension do not. And you need to know a rough estimate of the total annual amount you spend each year on daycare expenses, or the amount you will spend in the future. Once you've gathered this information, open this Google spreadsheet by typing in the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. In cell B1, enter in your federal marginal tax rate. It defaults to 22%. In cell B2, enter in your state marginal tax rate. It defaults to 4.25%, which happens to be Colorado's flat tax rate. In cell B3, leave it at 6.2% if you contribute to Social Security. If you do not contribute to Social Security, change it to 0%. In the rare case that you have a non-covered pension and FSAs come out pre-pension, enter in your contribution rate for your pension. For example, this applies to Colorado Para members with a membership date prior to July 1st, 2019, so they would enter in 11%. But this is very rare. The Medicare tax is 1.45% for everyone, so do not change this. In cell B7, put in your estimate of your total annual out-of-pocket medical, dental, and vision expenses. These include not only your expenses, but anyone in your family. The maximum amount for an individual in 2025 is $3,300. If you have a partner who also has an FSA, the maximum amount is $6,600. The default I put in is $2,000, but you should definitely change this to your estimate. In cell B8, put in the estimated amount of annual daycare expenses you have or will have if you anticipate having children in the future. The maximum amount for this is $5,000. The default I've put in is $5,000. If you have or will have kids in daycare, most likely you'll want to leave this at $5,000 as most people will have more than that each year in daycare expenses. The spreadsheet will then calculate your yearly and monthly tax savings for both years when you have kids in daycare and years when you do not. To the right, it also shows those savings if you were able to max out both the medical and dependent care FSAs using 2025 max numbers. As you can see, these are some decent numbers. With the default numbers I have inputted, you would save $2,373 a year during the year your kids are in daycare and $678 a year in the year they are not. And to the right, it shows the numbers if you're able to max out those accounts. These numbers are even better. Then let's see what this amounts to if we invest those savings. In cell B16, put your assumed rate of return. It defaults to 7%. In cell B17, put the total number of years you will be investing. This defaults to 30, just like it has in previous episodes. In cell B18, put the total number of years you expect your kids to be in daycare. If you don't have kids yet, but anticipate you will, put in the total number of years you expect your kids to be in daycare in the future. The spreadsheet will then calculate your total projected investment earnings after X number of years, default of 30. And to the right, it will also calculate what the maximum investment earnings would be if you were able to max out your FSAs. As you can see, these are some pretty significant numbers. With the default numbers I entered, including having kids in daycare for a total of 8 years, you would have over $60,000 after 30 years. And even more if you're able to max out the accounts, or if your kids were in daycare for a total number of years more than 8. Note that all these numbers are assuming 2025 maximum contributions and your current tax rates. Since contribution amounts and your expenses will go up over time due to inflation, if anything, these numbers are an underestimate. If you are taking notes throughout this series, take a screenshot of your spreadsheet and paste it into your notes, as well as a link to your copy of the spreadsheet for future reference. Then write a paragraph or two reflection on this exercise. Now, as promised, we are going to look at the incredible opportunity an HSA qualified HDHP provides you. As mentioned previously, you have to do the math to see if the HDHP your employer offers is at least as good as the PPO offerings. If your employer doesn't offer an HSA qualified HDHP, you can skip this part, but I encourage you to follow along anyway for future reference and to help others you know. The following assumes that either an HSA qualified HDHP is your only choice, or that if you have multiple choices, you've done the math and decided the HDHP is a good fit for you. If you have a choice between a PPO and an HDHP, you need to carefully evaluate whether an HDHP is right for you. To be clear, this exercise simply looks at the possibilities an HSA affords you. It does not help you evaluate whether an HSA qualified HDHP is the right choice for you in the first place. If you have an HSA qualified HDHP, you don't contribute to a medical FSA. Instead, you contribute to a health savings account, an HSA. Note that even if you contribute to an HSA, you can still contribute to a dependent care FSA if you have kids in daycare. In addition, some employers also offer a limited purpose FSA in conjunction with the HSA. A limited purpose FSA works just like a regular medical FSA, except you can only reimburse yourself for dental and vision expenses, not for medical expenses, because the HSA is for the medical expenses. What you cannot do is contribute to both an HSA and a medical FSA in the same year. It's one or the other. And you can only contribute to an HSA if you are enrolled in an HSA qualified HDHP. An HSA is similar to an FSA in that you contribute pre-tax dollars to it, so you get the same tax savings as the medical FSA like we looked at previously, and then can reimburse yourself later for medical, dental, and vision expenses. But an HSA has 5 major advantages over an FSA. First, it has a larger yearly contribution limit. In 2025, you can contribute up to $4,300 as an individual, or $5,300 if you're over 55, or $8,550 for a family, or up to $10,550 if both partners are over 55. Note that this total includes any employer contribution, so if your employer contributes to your HSA, which they often do, be sure to subtract that from the maximum before figuring out your contribution. The larger contribution amount compared to the medical FSA means you get an even larger tax savings. Note that once you're on Medicare, you can no longer contribute to an HSA, but you can still reimburse yourself from an existing HSA. Second, there is no use it or lose it provision. You can roll over your entire balance from year to year. This means you can make the maximum contribution to the HSA each year even if you don't have that many expenses, and then use that money to reimburse yourself for health, dental, and vision expenses in the future. Third, you can choose to invest the money in your HSA instead of just letting it sit there until you're ready to reimburse yourself. Fourth, you don't have to document your spending to reimburse yourself. Just ask for the money. Note that while you don't have to document it, I would highly recommend you keep that documentation in case you were to get audited in the future. Fifth, you don't have to reimburse yourself now. You can wait and reimburse yourself later, even for expenses you incur now. That may seem weird, but that allows you to use your HSA much like a retirement account. Let it grow over time and then have much more to reimburse yourself with down the road. This is the opportunity we're going to take a look at. Open this Google spreadsheet by typing in the link or clicking on the link in the slides. It will ask you to make a copy so that you have an editable version. Click Make a Copy. For this spreadsheet, you can simply observe the sample numbers that are there, or you're welcome to make changes to reflect your own circumstances. In cell B1 is your assumed rate of return. It defaults to 7%. In cell D1 is the family maximum contribution for 2025 of $8,550, if you're under age 55. Unlike the medical FSA, you would try to max this out every year whether you had this much expenses or not. If you're an individual, the max for 2025 is $4,300 if you're under the age of 55. Then the rest of the spreadsheet shows what your HSA will grow to if you invest the 2025 maximum each year going forward. Even though that maximum amount will go up in future years, this just assumes the 2025 maximum. So this is underestimating the potential. The key point to understand is that if you can afford to pay your out-of-pocket medical, dental, and vision expenses out of your regular cash flow, your spending and savings account, instead of reimbursing yourself immediately from your HSA, it allows your HSA to grow very large over time. And the truly amazing thing is that it's all tax-free. HSAs are called triple tax-free accounts because they are the only accounts where contributions are pre-tax, earnings are pre-tax, and withdrawals are pre-tax, as long as they are for medical, dental, or vision expenses. You never, ever pay tax on this money. You simply let it grow throughout your lifetime and then start reimbursing yourself later in life, typically around age 65. This is why it can be used as a stealth retirement account, and it's even better than traditional or Roth accounts because unlike those accounts, you never pay taxes on any of it. On the off chance that you don't have enough expenses to eventually reimburse yourself with, including your expenses all along the way and your expenses when you're older and healthcare costs frequently increase, you can still withdraw the money from your HSA after age 65 for any reason, even if it's not for medical and dental and vision expenses, and simply pay taxes on it, which means it functions just like a traditional pre-tax IRA or 401k. So the worst case scenario, and keep in mind this is a scenario where you don't have any healthcare costs, so it's a pretty darn good scenario, is that it acts like a traditional IRA, and the best case scenario is that it is much, much better than a traditional IRA. So take a look at row 43, the total after 40 years. 40 years may seem like a long time, but if you start this when you first start working as an adult and don't start reimbursing yourself until age 65, you will end up doing this for at least 40 years. After 40 years, and even not increasing the maximum contribution amount each year going forward, which you likely would, you would have over $1.7 million. And that $1.7 million is completely tax-free. It was never, ever taxed. This is why the HSA, if you can afford to use it this way, is the best retirement account around. If you're taking notes throughout this series, take a screenshot of this spreadsheet and add it to your notes for reference. I'd also suggest adding a link to your copy of the spreadsheet so that you can return to it if you want to. Then perhaps write a paragraph or two, or more, reflection on the possibilities of HSAs. It's important to understand what your choices are so that you can make the best decisions, and yes, you may have to do a little bit of math to figure out what your best choices are. If you go with a PPO, be sure to take as much advantage of the medical FSA as you can. If you go with an HSA qualified HDHP, try to max out your contributions each year. Don't reimburse yourself right away, and invest it and let it grow for as long as possible. If your employer also offers a limited purpose FSA, consider contributing a little bit to that as well to reimburse yourself for dental and vision expenses along the way. No matter which type of health insurance you have, also be sure to take advantage of the dependent care FSA if you have kids in daycare. Finally, a brief comment on the supplemental insurance offerings your employer may offer, such as accidental death and dismemberment insurance, critical illness insurance, accident insurance, and similar choices. As always, this is an individual decision, but in general, I would recommend not taking any of these supplemental choices. Again, the purpose of insurance is to protect against catastrophe, and any catastrophic events that these supplemental choices are protecting you against are already covered by other insurance. These just help you pay the bills. And like all insurance, the expected outcome when you buy these policies is that you will lose money, with a very few, and unlucky, people coming out way ahead. It's better to save and invest the premiums rather than pay for these supplemental policies. The one important exception is disability insurance. This varies tremendously by employer. Some employers pay for disability insurance for you, or if you pay into a pension plan, your pension plan may have built-in disability. But it's really important to know what coverage you have, and if you don't have adequate coverage provided for you, purchase disability on your own, either through your employer or on the open market. While many people think a lot about life insurance, which we'll talk about more in our next episode, when you are fairly young, becoming disabled is the much more likely event and can be devastating if you don't have disability insurance. So make sure you have coverage. If you're comfortable sharing any of your reflections from this episode, there are several ways to do that. If you're watching or listening to this on Spotify or YouTube, then you can leave your thoughts and/or your feedback or questions in the comments. You can also always reach out to me directly on social media or via email. I'm Carl Fish on Blue Sky, Twitter, Facebook, and YouTube, or you can email me directly at carlfish@gmail.com. In our next episode, we'll take a look at additional insurance options that you typically get on your own instead of through your employer.